welcome to our new video. Today, we are going to discuss financial system analysis, an essential process that helps businesses and investors evaluate financial performance. Whether you're a business owner, an investor, or just someone curious about finance, this video will help you understand financial analysis in a simple and practical way. So, let's get started. What is financial system analysis? Financial statement analysis is the process of analyzing a company's financial statement for decision-making purposes. External stakeholders use it to understand the overall health of an organization, as well as to evaluate financial performance and business value. Internal constituents use it as monitoring tool for managing the finances. Analyzing financial statements. The financial statements of a company record important financial data on every aspect of a business's activities. As such, they can be evaluated on the basis of past, current, and project performance. In general, finance statements are centered around generally accepted accounting principles, GAAP, in the U.S. These principles require a company to maintain three main financial statements: the balance sheet, the income statement, and the cash flow statement. Public companies have stricter standards for financial statement reporting. Public companies must follow GAAP standard, which requires accrual accounting. Private companies have greater flexibility in their financial statement preparation and also have the option to use either accrual or cash accounting. For more detailed information, visit the official website of VMK Professionals, www.vmkpros.com, and always review the latest amendments before execution, as laws keep changing frequently. As mentioned, there are three main financial statements that every company creates and monitors: the balance sheet, income statement, and cash flow statement. Companies use these financial statements to manage the operations of their business and also to provide reporting transparency to their stakeholders. All three statements are interconnected and create different views of a company's activities and performance. Financial statements are the primary source of information for assessment of financial impact of business operations of the company during a year, financial position of its assets and liabilities at the end of the year, and changes in flow of cash from operating, financing, and investment activities during the year. Includes I, a balance sheet; T, a profit and loss account; E, cash flow statement for the financial year; V, a statement of changes in equity; and V, explanatory note. The balance sheet is a report of a company's financial worth in terms of book value. It is broken into three parts to include a company's assets, liabilities, and shareholders' equity. Short-term assets, such as cash and accounts receivable, can tell a lot about a company's operational efficiency. Liabilities include its expense arrangements and the debt capital it is paying off. Shareholders' equity includes details on equity capital investments and retained earnings from periodic net income. The balance sheet must balance with assets minus liabilities, equaling shareholders' equity. The resulting shareholders' equity is considered a company's book value. This value is an important performance metric that increases or decreases with the financial activities of a company. The income statement breaks down the revenue a company earns against the expenses involved in its business to provide a bottom line, net income, profit, or loss. The income statement is broken into three parts, which help to analyze business efficiency at three different points. It begins with revenue and the direct costs associated with revenue to identify gross profit. It then moves to operating profit, which subtracts indirect expenses such as marketing costs, general costs, and depreciation. Finally, it ends with net profit, which deducts interest and taxes. Basic analysis of the income statement usually involves the calculation of gross profit margin, operating profit margin, and net profit margin, which each divide profit by revenue. Profit margin helps to show where company costs are low or high at different points of the operations. For more detailed information, visit the official website of VMK Professionals, vmkpros.com, and always review the latest amendments before execution, as laws keep changing frequently. The cash flow statement provides an overview of the company's cash flows from operating activities, investing activities, and financing activities. Net income is carried over to the cash flow statement, where it is included as the top line item for operating activities. Like its title, investing activities include cash flows involved with firm-wide investments. The financing activities section includes cash flow from both debt and equity financing. The bottom line shows how much cash a company has available. Companies and analysts also use free cash flow statements and other valuation statements to analyze the value of a company. Free cash flow statements arrive at a net present value by discounting the free cash flow a company is estimated to generate over time. Private companies may keep a valuation statement as they progress toward potentially going public. Financial statements are maintained by companies daily and used internally for business management. In general, both internal and external stakeholders use the same corporate finance methodologies for maintaining business activities and evaluating overall financial performance. When doing comprehensive financial statement analysis, analysts typically use multiple years of data to facilitate horizontal analysis. Each financial statement is also analyzed with vertical analysis to understand how different categories of the statement are influencing results. Finally, ratio analysis can be used to isolate some performance metrics in each statement and also bring together data points across statements collectively. Below is a breakdown of some of the most common ratio metrics. Balance sheet, asset turnover, quick ratio, receivables turnover, days to sales, debt to assets, and debt to equity. Income statement, gross profit margin, operating profit margin, net profit margin, tax ratio efficiency, and interest coverage. Cash flow, cash and earnings before interest, taxes, depreciation, and amortization. These metrics may be shown on a per-share basis. Comprehensive, return on assets ROA and return on equity ROE. Also DuPont analysis, a specific format as per Schedule 3 of the Companies Act 2013 has prescribed for preparation of financial statements of the companies. In this Schedule 3, about 2 different formats of financial statements for Ind AS and non-Ind AS companies mentioned. Annual report is a very important annual document which has both financial information and non-financial information, including that of industry and competition, segment reporting of business, related party transactions, and accounting policies and principles in general, and specific to certain transactions. The listed companies are additionally required under CB regulations to make and file their quarterly profit and loss account and half-yearly balance sheet with stock exchange. These interim periodical fillings are available on the website of Stock Exchange and also of the company. Financial analysis is a process of identifying the financial strength and weakness of the enterprise by correlating the relationship between balance sheet, profit and loss account, and cash flow statement. Financial analysis is normally done by management and by other stakeholders. The management, including the joint venture partners, would be concerned in every aspect of the financial analysis. They will be interested in assessment of effective and efficient use of resources. The investors will be interested about the earnings of the enterprise. Such investors will have more confidence in those enterprise. Those show steady growth in earnings. Out the financial structure, to the extent it influences the earning capacity as well as the level of risk. The bankers and suppliers of long-term are interested with long-term solvency of the enterprise. They carry out the analysis of the profitability over a long period and assess its ability to generate the cash so that the enterprise be able to pay the interest and principal on due dates. The long-term suppliers do carry out analysis of historical financial statements as well as projected financial statements. The suppliers of short-term are interested with short-term solvency of the enterprise. They carry out the analysis of the short-term liquidity position of the enterprise. Balance sheet reflects the assets and liabilities of the company at a point in time. The difference between assets and liabilities is called equity, which is attributed to the owners or shareholders of the company. The accounting equation can be presented as assets equals liabilities plus owner's equity. Profit and loss account reflects the revenue and expenses of the company and the resulting profit made by the company from its business operations and represents its financial performance during a period of time. Cash flow statement reflects the sources and deployment of cash of the company from operating, investing, and financing activities of a business during a period of time. For more detailed information, visit the official website of VMK Professionals, www.vmkpros.com, and always review the latest amendments before execution, as laws keep changing frequently. Performance analysis. Financial ratio is a relationship between two financial variables. It helps to ascertain the financial conditions of the enterprise. Ratio analysis is a process of identifying the financial strength and weakness of the enterprise. It involves comparison for a useful interpretation of the financial statement. A single ratio in itself does not indicate any favorable or unfavorable condition. It should be compared with some standards such as past ratio, competitors ratio, industry ratio, as well as projected ratio. Types of ratios. Various ratios, calculated from the financial statements, can be classified based on activity or function to be evaluated. We may classify these ratios into the following. Liquidity ratio shows the ability of the enterprise to meet out current obligations. Leverage ratio measures the proportion of debts and equity in financing. Activity ratio measures the efficiency in utilizing the assets. Profitability ratio reflects the overall performance and effectiveness of the enterprise. Liquidity ratio. It provides a relationship between cash and other current assets with current obligations, which provide a quick measure of liquidity. The enterprise should ensure that it does not have excess liquidity and also that it does not suffer from lack of liquidity. The most common ratios, which indicate the extent of liquidity or lack of liquidity, are current ratio and quick ratio. There are other ratios such as cash ratio, IV, interval measure. Current ratio. Current ratio is calculated by the formula as given below. Current ratio equals current assets, current liabilities. Current assets include cash and other assets that can be converted into cash within a year, such as debtors, inventories, and marketable securities. Current liabilities include all such obligations which are maturing within a year, such as creditors, bills payable, short-term borrowings. As a conventional rule, a current ratio of 2 to 1 or more is considered satisfactory. Quick ratio. This ratio is also called acid test ratio. It reflects the relationship between quick or liquid assets with current liabilities. An asset is liquid if it can be converted into cash immediately without a loss of value. Cash is most liquid. The inventories are considered to be less liquid. The inventories normally require some time for realization into cash. Their value also has a tendency to fluctuate. Therefore, for the purpose of calculating the quick ratio, the inventories are to be excluded from the current assets. Quick ratio equals current assets minus inventory divided by current liabilities. As a conventional rule, a quick ratio of 1.1 is considered satisfactory. Cash ratio. This ratio represents the relationship of cash and cash equivalent to current liabilities. Trade investments or marketable securities are equivalent of cash, therefore, they are included in the computation of cash ratio. Cash ratio equals cash plus marketable securities divided by current liabilities. Interval measure. This ratio reflects the ability of the enterprise to meet its regular cash expenses. Daily operating expenses will be equal to cost of goods sold plus selling, administrative and general expenses less depreciation. Interval measure is calculated by dividing liquid assets by average daily operating cash outflows. Interval measure equals current assets minus inventories divided by average daily operating expenses. For more detailed information, visit the official website of VMK Professionals, www.vmkpros.com, and always review the latest amendments before execution, as laws keep changing frequently. And that's it for this video. We hope you learned something new about financial system analysis and how it helps businesses and stakeholders make informed decisions. Don't forget to like this video, subscribe to our channel for more finance-related content. Thanks for watching, and we'll see you in the next video.